Jim Sackman, your Focal Point Business Coach, and this is another of our Success Friday videos about financing your business. And this time I'm going to talk about factoring. And factoring is a different kind of financing for business, and it's generally used to cover short-term cash flow issues. Now, let me use an example of where you might occur it. Let's say you're in construction and you're going to do some work on a commercial office building. The building might require a new roof. Now, to get paid, you got to complete the job and wait for the check after you've invoiced the business for the money. But before that, you've had to buy materials and you've had to hire and pay employees to do the work on this roof. Now, most invoices are net 30, which means that they're due within 30 days after you've received the invoice, and that's called net 30. But some businesses don't pay for 45 days, 60 days, and that's even if they've got credit and money and don't have problems. So you can have a gap from the time that you start the project and spend the money, sometimes on the order of 90 or 120 days. And essentially you're financing your customer. You're giving them a loan during that period where you've done this work, but you haven't gotten paid for it. Now, some industries, like the sign industry, tend to have upfront prepayments of money to cover the material costs of the project, but most industries does not. So now, how does factoring work with this? Factoring is a very simple solution. You essentially sell that invoice to somebody else who's going to collect the money later. Now, of course, when you do this, they're not going to pay 100% of the face value of the invoice. So if you've got a $10,000 invoice, you might get $9,000, you might get $8,000, depending on how long the payment terms are for it. And the reason that that person might do that, of course, is they earn really good, the equivalent of interest for financing this invoice for a short period of time. Now, one of the really important parts of this is that really the business's credit, the person who's selling the invoice, their credit really doesn't matter. What really matters is the credit worthiness of the customer. So let's say you're a small general contractor and you're not putting a roof on a commercial building, but you're building a cell phone tower for AT&T. AT&T has wonderful credit and is going to pay the invoice, assuming you actually built the cell tower. And so it's a really good way to use somebody else's credit to have some financing for your business. And it can really help small businesses do business with large ones. So that's a lot about factoring, a bit of an expensive way to manage cash flow. This is Jim Sackman from Focal Point. Change your business, change your life, and have a great day.